I'm Charlotte McLeod with investingnews.com, and here today with me is Brian Leni, founder of Junior Stock Review. Thank you so much for joining me. Great to have you online as usual.
Thanks for having me, Charlotte.
Of course. So we have a lot of things to catch up on today, but where I want to start is with some recent news from you. So you're launching a new series on YouTube. It's called Field Notes. And as I understand, this is going to be a series that follows you as you make site visits to companies, as you talk to the CEOs there. I know how much you enjoy site visits, so this makes total sense to me. I wondered if you could start off by telling me a little bit about that and what people should know about it.
Yeah, Field Notes follows me to the companies I'm investing in, in the Junior Stock Review portfolio. And I'm in a sort of privileged position to be able to go to site and, visit these companies sometimes before I invest and sometimes after. And so what I wanted to do is bring my readers, viewers along with me to site and see what I see, see the layouts of these projects, the proximity to other projects, the infrastructure access, the little towns and social kind of license that comes with these companies being in the area. And to me, site visits have been such a X factor in terms of the investment process. And I really think the visual aspect of it should be appealing to investors, and it should at least, get them to start asking more questions, maybe about those companies that I'm showing them, and also about companies in general, more questions to ask in that vetting process that they have at conferences or on phone calls and such.
Yeah, as I said, it makes a lot of sense to me because we talk about site visits, maybe not every time that we meet, but frequently. And one of the things you always tell us is they're so valuable, but of course, not everyone can do them. So this seems like a great way to bring people into the process. And the videos are really well put together. You've got, I believe, 2 up on the YouTube channel, which we will link to in the video description, 2 up currently. I did wonder if you can share any future projects that you may be visiting, anything that we can look forward to.
Absolutely. So the first episode that you'll see on the Field Notes YouTube channel is basically all about me and about what I'm going to do in my thesis behind the whole Field Notes channel. The second episode is actually a site visit to FPX Nickel's Dakar Nickel District in central BC. And we've talked about it before in interviews. I've been an investor in FPX for quite a while, and it's been a fantastic company to cover in my newsletter and as a shareholder. At its peak, it was a 10-bagger for us. It's come back off that high, but it's definitely brought us some profit. So for me, maybe it hasn't brought the investment full circle because FPX hasn't been bought out or they're not in production yet, but it was really a cap to me for that process to go there to site, see the project, spend time with Martin Turen, the CEO, and see, the layout of a future open pit nickel mine, which I think it is going to be. And we're going to look forward to that episode. I'm hoping to publish it just after Thanksgiving, or Canadian Thanksgiving, that is. And so people that are interested, look at the Field Notes YouTube channel after Thanksgiving, and you'll see it there.
Okay, really good. So as I said, I'll leave the link to the channel in the video description so everybody can go and hopefully check it out. This sounds like a really good new project, and I've really enjoyed watching it so far. So we'll also look today at a couple of the areas of the resource sector that you're watching right now, and I'm going to begin with precious metals. So you told me before we started this interview that you remain bullish on precious metals. So not a surprise to me. You've been very consistent in that as we've been speaking this year and, of course, previously. But it's an interesting time to be talking about that because as we're speaking right now, we have gold below 1900. Maybe the sentiment isn't looking so strong there. So I wanted to ask you about that. Maybe it'll be back up by the time we end up posting this video. We don't know. But yeah, looking at gold and maybe just some of the pressure that it's facing at the moment.
Yeah, the market's tough. And I think considering all the things that are going on in the world, whether it's financial or social, I think, all roads sort of lead to precious metals, in particular gold. Whether it's, the mounting debt, the interest rate decisions by FOMC. Last week they decided to keep the playing field level, no hike or reduction. But they're hinting at a future hike, and all these things sort of play into what people think is going to happen with the gold price and probably the U.S. dollar being its counterpart. And so that strength in the US dollar that we've seen and some of the uncertainty, I think, has led to the drop in the gold price over this last week. But to me, it's just kind of a blip on the map. And really, what I see is gold and precious metals are real money, and they will end up being the backbone of, I think, a lot of investors' portfolios moving forward. And because of the move to CBDCs and all those other things that I described, when you go down to the equities, and I think that's where the real opportunity is, and it comes with much more risk. But if you look across the sector, there's a number of really good companies selling at massive discounts to their underlying value. And for me, the process has been more sorting through all that and trying to decide what I want to invest in and what I think the market is going to eventually give market recognition, almost irregardless of where the gold price goes. Because, no matter how you look at it, around $1,900 gold is still a very good level. And while it's come off, from that blip we had over the last month or so, I still think it looks like a very good gold price to project forward. And for me, I like to look at companies that have existing resources or economic studies and kind of put my own spin on where I think that company's headed along with their catalysts. And so I see a ton of opportunity in those equities, and I'm looking to deploy some cash. If you go back actually into how I was moving the portfolio earlier this year, I took profits on some of our winners, and I also got rid of some of our losers to build up a cash position to deploy sort of in this last quarter, hopefully to take advantage of potential tax loss selling and just the amount of choice that we have. Because again, I think it's one of the best opportunities I've seen since I've been an investor in the sector.
Okay, really interesting. So let's check back on that. So you're looking to deploy cash right now, and I remember you said when we spoke in January that developers, at least in precious metals, were the sweet spot for you. So is that still your stance?
Absolutely. I think that's where the best value is. There's rightfully a lot of attention on the critical metal side of things and energy, and I totally see that. But I don't necessarily think the differential between underlying value and potential, or what I see as the potential value, is there as much in some of the critical metals and energy sector of the developers. So I tend to like the things that have more of a discount. And just as long as I see that they've got cash and they've got some catalysts on the horizon, that's where I see a ton of opportunity. But you do have to be picky. You do have to be picking the right companies. It's a stock picker's market. And you have to be very careful, because the other side to it is, with this looming recession that, many people have been calling for many months now, I don't know if it necessarily has come yet, but if it does come, I think it is going to bring with it some turmoil. And to some people, that's going to scare them away. And to others like myself, I see even more as opportunity, whether it's tax loss selling or some sort of weakness and blow off, sell off. To me, it's definite opportunity.
Yeah, I think definitely we'll come back to that recession question. But first, I want to ask a little bit more about those precious metals developers. So you mentioned there's a lot of opportunity, but you still have to be picky, right? And you shared with me some metrics that you look at when you are evaluating these precious metals development companies. So I wondered if you could speak a little bit about that, because of course it's different than the juniors and the majors that people might be more used to looking at.
Absolutely. So one of the overlying or high level metrics I look at is the price to value ratio. And I kind of alluded to that in the last question. And so I'm looking for that discount on underlying value. And I compare that market cap to the value I project in a discounted cash flow model or some sort of valuation that I do on the company. So that's first and foremost. And obviously the bigger the differential, the more interested I potentially become. Secondly, with these companies, they have an underlying resource or they have an economic study. And I want to look at that CapEx to after-tax NPV, specifically the ratio between the two. And the higher the ratio, meaning the more NPV the project can create over its mine life, compared to the upfront CapEx that's needed to build that mine, the more safety factor I think you have in most cases. And so you have to do some due diligence, and you obviously have to see if what is projected by the company makes sense and is realistic. But if you can find companies that have ratios, well above 2, I think you're getting a really good bang for your buck. And there's a few companies out there like that. The only contrast is sometimes they're not selling at a discount. Sometimes the market recognizes the value, and really you're either paying more than you should or you're paying fair, which depending on your outlook and your risk level, maybe that's okay. On the other side of things, NPV to CapEx ratios that are around 1, meaning you're basically creating as much money as it costs to build the project. I think you need some intangibles. And by intangibles, I mean, these projects are located by existing operations that have maybe some future hole in their capacity, their mill capacity, that they're going to need another mine to come in and fill that. And so that potential M&A transaction, I think is very realistic. These mining companies are continually depleting their coffers or their resources. And so they have to go out there and look. And if I was an investor, what I would do is if you can go find some mining operations and basically draw a 50-kilometer circle around it, a radius, and say, hey, where are all the most interesting deposits around there, the most advanced, the best looking, and how would that might fit in to this existing operation when that mine life will be over, and how this potentially higher grade or equal grade, same type of mineralization could be used in there. And I think those sorts of opportunities are something that the market typically misses. And so if you do enough due diligence, this can be an opportunity for investors.
Okay. So some of the similar characteristics that we would look at for other stages, but with a different twist on them. And okay, so I think that another reason why the development stage might sometimes be overlooked is it's kind of known as a bit of a dead zone in the life cycle of a company, right? Where they're working on things, they're trying to move forward, maybe they're trying to raise money, but it's not as exciting. So for somebody who is looking at these companies and trying to enter, what does the trajectory of that investment look like?
That's a fantastic question and a very astute observation. Yeah, some of these developers can fall into that bottom of the Lassonde curve and be forgotten. And in some cases, some of these companies are rightfully forgotten. There's reasons why they're selling at a discount, and you as an investor have to find those reasons why. Then the other side is you find these companies that are selling at a discount. You need to find the reasons why the market should take notice and recognize that value in the company. I think probably the biggest point you want to look at is expansion potential. So, a lot of these companies will have existing resources. Let's say it's 1 million ounces of gold, open pitable and such, right? You want to see if they can expand that deposit at depth, or maybe they can find other deposits. Maybe there's some great geophysics and geochemical anomalies within, the proximity of that existing deposit. And, they've got the baseline stuff done, and they look to expand. And I think, exploration success is definitely something that I've seen the market recognize. The others can be, they're more complicated, but, increases in mineral processing and metallurgy, tweaking processes using existing technology to gain extra percent on your recoverability of gold, or whatever it is. These can make huge impacts to discounted cash flows, and it can really help NPVs and can surprise the market that's not looking for it. So, items like this, these catalysts that have impact, that can expand the resource or improve recoveries, this is a sort of along the lines I think that people need to be looking at in terms of getting out of that dead zone and getting some recognition for the value. Because you're absolutely right. For the companies that you unfortunately pick wrong, they will probably stick at a discounted price for a long period of time. And I've made those mistakes myself, but I'm trying to minimize those. And through experience, I'm doing better as I go along. So that's definitely the opportunity in the developers.
Okay, very, very good to hear. And thanks for going over that. I think it makes a lot of sense. So for you, these developers are the sweet spot right now. We've gone over that. But to be clear, I imagine that doesn't mean you're entirely discounting the juniors at the moment. So maybe we could talk a little bit about what's going on there and what people should be looking for when it comes to juniors in the precious metals sector. Because although we have that historically high gold price and this decline is probably a blip on the radar, as you said, they're continuing to face problems like inflation, et cetera, the recession that we will again come back to. So tell me how you're approaching that.
So exploration, I think, is one of those segments. It's definitely on the far end of the risk spectrum. And so for that, I'll give you how I look at it. And so for exploration, I definitely want to have a good sense of who management is, their experience, what successes they have had, what process they're going to apply to explore the land packages that they've secured. Most of the time, if you get the people part right, the other stuff, especially on the exploration side, is going to give you the best chance to be right in the end. And I think you definitely want to start there. After that, I think the stuff that I look for is definitely location. You want to be near, I think, other big deposits, but you want it land that hasn't been explored before. So large land packages next to large ore bodies from the past, and have the team has a sense of how they're going to explore it, and has that experience and technical expertise to do it, right? So if you've been looking for gold deposits undercover all your career, that's probably where you should stick. And there's some companies like, let's say, Kenorland Minerals. Zach and his team, they're experts at exploring for gold deposits undercover. And if you're looking at a land package that has glacial till over it, these are the guys, or the type of guys you want to look at to explore that type of thing. So, connecting the people and the type of project, I think, is huge. And of course, the larger the land package, I think the more chance you have, a probability of being successful. So I think those are two big points, and those are the ones that I look at. And then the third one, I guess, in this type of circumstance is that they have access to cash, because people can have great ideas, but if they don't have the money to actually put it to work, then it's not a good scenario. And so in this type of market, there are certain groups that seemingly can raise money no matter what. And these guys have the reputations, and they have the experience behind them, and people will make sure they're funded. And so I think definitely in this type of market that we're in, you want to look for those guys. And those are the guys that I think are going to give you the highest probability of success.
Okay, so kind of sticking to the basics there, I think that makes a lot of sense. And so now let's look at that recession question and kind of your macro view on what's going on right now. I feel like, yeah, definitely in our last several interviews, we've been talking about what's going on. Are we in a recession? Are we heading to one? What's happening? And now we have interesting things going on with the Federal Reserve. They've been able to go so much further with their rate hikes than people expected. And it's looking like one more this year before maybe in 2024, we eventually start to come back around. So tell me a little bit about what you're seeing at that macro level and how it's influencing your investment strategy.
I definitely have to agree with a lot of the broader market commentators that say, they've seen a recession coming. Like, I think everybody has sort of had that sense that with interest rates gone or are where they are, that it's putting a tremendous amount of pressure on regular people and industry. And so you would think over time that this is eventually going to unwind. But what I've learned in the past is, like, typically with those things that maybe are seemingly obvious or a lot of people agree with, it doesn't always happen that way. And I'll be quite honest with you, after 2008 and all the quantitative easing we had, I thought to myself, we're going to be much closer maybe to the position we're in today 10 years ago. And quite frankly, we weren't. And we kind of just plodded along sideways. And so I guess my point is this. I don't put a lot of stock into being able to predict where the market's going. And an experience has shown me that I'm really not that great at predicting the future. And so I'm cognizant of the risks, but I still employ the same process of looking at junior equities that I have forever. And there might be some subtle differences, maybe in jurisdictional risk that I'm willing to take and where I'll put my money versus now versus previously. But really, I kind of plod along and look for good juniors that are selling at a discount, that got good management team, access to cash, and have the catalyst to move their share price up. It doesn't always work out, but that's kind of the process that I've always taken. But more along the lines to your question, I think a recession is coming at some point. And I think when you look at past recessions, usually the worst of it is the pre. And once you're actually in the recession, things do have a tendency to turn around, and they can turn around quite quick. And stuff like gold, and I think if they do follow up with quantitative easing, I think you're going to see all those base metals shoot up, and copper, nickel, all these other base metals are going to have a real push, because I think the government's going to have no choice but to flood the market with money. And so this kind of preamble up to that precipice is terrible, but I think it's the worst of it. And so once we get past wherever this bottom is going to be, I think things look really good.
Yeah, so at some point we rip that Band-Aid off and hopefully we start turning around. We'll see when that happens. I also don't have a crystal ball. Um, but I think what you're saying here relates to another topic that I wanted to touch on. You had sent me a piece of writing that you did about oil and your interest in oil, and kind of the gist of it, you can go into more detail, I'm sure, was that you're interested in oil even if we are heading toward this recession scenario. So tell me what you're thinking there, because I know some people look at that and they say, oh, maybe we don't want to be in things like energy, industrial kind types of commodities.
Well, one thing is, like, just to say overarching, energy in particular is the basis for our lives. And if we want to keep the sort of daily life that we're used to, especially oil is going to be a huge part of it. If you want to drive to the store, if you want to go on an airplane or a trip anywhere, in some cases have the lights to come on, you're going to need that power, that energy from somewhere. So I think the baseline is there. I think the tendency, especially with oil, is to look back onto, the COVID era, like 2020. And we had this situation where, oil went negative and it was a major impact. I can remember, seeing it minus $25 a barrel. It's a mind warp, But I think if you stay in that mentality and you have that recency bias and you look back at that point, you say, oh, I'm hyper negative. If we go into a recession, oil is going to do this or it's going to do that. Well, in the interim, I think it would have a negative effect, but it's not going to be the same as COVID. The world isn't going to be shut down as far as I can tell. And we're going to have to keep on living our daily lives. And so to me, even though oil is, let's say, $90 per barrel today, maybe you come back to $70 or $65 or something along those lines. But to me, that's probably pretty close to where the bottom is. If you look at the last decade, all the super majors, ExxonMobil, Shell, if you look at their research and development when it comes to new oil fields, I'm telling you, the curve falls off a cliff and they're billions of dollars behind. And that's a decade. Not only that, but you saw a spike in shale oil out of the States, and right in 2014, I think it was, basically the US became the world's #1 oil producer. And it was on the back of this huge shale oil. Really, we look at the rig counts, you look at the production numbers out of the Permian Basin or any of the other shale oil or major areas, they're all, again, look like they've peaked and are on their way down. Even with this $90 barrel per oil, things still seem to be trending on the downward slope. You mix in, Biden's move to get rid of or sell 50% of the strategic reserves, the U.S. strategic reserves, and they no longer have that kind of stranglehold or kind of threat of a strategic oil reserve, right? They've got 50% of what they used to have. And unless they build that back up, which would be good on the demand side, or if they're going to get rid of that further, it just pushes out, I think, to me, the timeline to when the oil price invariably has to go up. The other thing that's happened sort of in this last couple of years is you have the advent of the net zero carbon emissions, which I think there's a lot of reasons for society to move in that direction. But I think people have to realize, especially investors, this is probably about the most bullish thing for fossil fuels that could have maybe ever happened. And there's been ESG has moved so much money out of fossil fuels that you've invariably impacted the supply side of the coin. And the thing is the demand side hasn't changed. With all the money that's been put into the alternatives and renewables, it's barely scratched the surface on how much we use fossil fuels, in particular oil. And so for me as an investor, I look at those things and I'm like, you know what? That's opportunity. That's opportunity for me. And I look at the oil market, and you can go from the seniors all the way down to the juniors. And I think there's a lot of compelling cases for investment in oil or coal or nat gas. And especially we'll see this winter how Europe is affected with, the Germans' policy decisions that they've made over the last, let's say, year and a half. And it'll be really interesting to see what happens. And then I guess the last kind of figure is what's gone on with this Russian-Ukraine war, the financial sanctions, and then kind of invariably how it flows into OPEC plus and, their push to cut production by 1 million barrels per day. And they've been very stringent with that. And we've seen the oil price now really respond. And unfortunately, I think that $100 per barrel of oil will become too much of the normal and might be closer to the low than the high. So for me, I've put some money into oil. It's probably the bigger portion of my portfolio at the moment, and I've been right. And I think, like I said, unfortunately, that probably goes a little bit further, and that creates, a cost of living to go up for everybody. And so it'll be interesting to see how that kind of flows out as we move on.
Definitely interesting. And so you mentioned in oil, there's opportunities across the spectrum. You have a big chunk of your portfolio there. I know you just went into all the factors you should look at when considering stocks in the mining sector, but oil, I think, is a whole different ballgame. I don't know if we have enough time to go into everything right now, but any special considerations that you would really want people to be aware of when they look at oil stocks?
Yeah. Well, I think one of the biggest things too, the biggest difference between the oil or natural gas companies and then the hard rock companies is an oil exploration company goes from discovery to production basically in the same day. Whereas in the hard rock case, you're talking like a decade, I don't know, 15 years before hard rock discovery is delineated, de-risked, and put into production. So there's still major risk when it comes to oil exploration, 100%. But if you've got a company that's got, a good base of production, they've got good positive cash flow, and they've got good prospects for expanding their production through exploration, and they can basically pay for it themselves through the cash flow that they're generating. I think these are extraordinary opportunities, and that's kind of the position I took today, or in this year, was investment in a junior that had a good small production rate, and they have the chance to double it within this year. And you mix in a higher oil price, and wow, you can really see how the share price recognition could lock in by the market. But there's so many examples like that, especially on the high end. You've got companies that are paying 10, 12% dividends, and these are thousands of barrels per day oil producers located in Canada and the States, and you can capitalize on that. So yeah, I think there's a ton of opportunity there, and just depending on your risk level and kind of how you see the market, can kind of direct you.
Okay, and just briefly, I can see from what you're saying why you would hone in on oil when you're looking at the energy sector, but there's so many different aspects of energy. And one thing I hear quite frequently is, well, we're going to need all of it. So, are you looking in any other areas of the energy sector at the moment?
Yeah, of course. I'm always looking. I think uranium is definitely a part of that. The one thing that I tend to shy away more from uranium is because of how much hype surrounds it. And usually because uranium is interesting because you do have an opportunity to actually buy the physical metal, through the Sprott Trust. And I think if you're really bullish on uranium, especially for a generalized investor, that's probably the investment. If you think uranium is going to go up, that's probably the investment vehicle you should look at. It's got the least amount of risk, and it's actually a real investment. They actually have U308, and that's what they're buying. The juniors on the other side, a lot of them, especially the higher quality ones, their valuations, I would say, are probably at fair value or maybe even above that. And so the uranium price almost has to go up for you to make any money. And I don't like the margin of safety that's equated with that. I'm usually looking for more just in case I'm wrong, because you just never know what's going to happen in the market. Next to that, I think coal is super interesting. And I think that natural gas, again, those are sort of in the same lineage of oil. But I think these are interesting opportunities. Another thing, Charlotte, I looked at a renewable company in the States earlier this year. They're a solar, wind, and sort of microgrid company. And again, there's so much to learn about these individual sectors, and that's sort of what scared me away, kind of getting over that learning curve. But I think, again, if you pick the right company and the company's got the right sort of business model, I think you can make money in just about any part of this energy sector moving forward, and especially the renewables. On the other hand, because there's going to be a lot of government funding that's going to be pushed towards it. And if you look at the Inflation Act that the states did last year, $300 billion of it was focused on the renewables, and so I don't see that changing.
Okay, I think that gives me a better idea of kind of how you're looking at it. And you did read my mind. I wanted to hear about uranium, especially during this time when it's kind of popping off of it. Okay. So that gives us a good picture of what you're looking at in precious metals and energy. I think we can wrap up there, but I'll put it back to you in case you had any final thoughts that you wanted to leave investors with right now.
I think there's tremendous opportunity in the market. And I think, first and foremost, investors have to look at themselves and say, what do I want to invest in? What's my risk level? How much do I know about that individual market? And what's my timeline for profits? Is it a weekend? Is it 2 months? Is it 3 months? Is it a year? And I think once you sort those things out and you actually write it on a piece of paper, I think that is where you can start getting directed and be more personalized in the companies or the metals that you're investing in. And I've made, mistakes in the past because I didn't do that. But these days, that's where I start. I start with myself, what I'm looking for, and then I project that onto the companies that I find. And I think many more people will be successful, especially in a market like this where there's tons of choice, and profitability in the next year.
Okay, this was really good. Thank you so much for coming on to talk about what's going on in the resource sector. Very, very informative.
My pleasure. Thank you for having me, Charlotte.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Brian Leni with Junior Stock Review. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.